In video chapter 1 of the Solvency II capital requirements that include risk capital, market value margins, technical provisions for the 1-year risk horizon, we're going to discuss insurers' solution to these Solvency II metrics, and we're also going to show that the arguments are non-circular and also are mathematically tractable, contrary to a lot of other opinions. So let's start with our website. And on the front page of the home page of our website, if we go to Solvency II, and then we go to Solvency II Capital Requirements, Technical Provisions, Market Value Margins, and Cost of Capital for the 1-year and ultimate year risk horizons. We're only going to discuss the 1-year risk horizon, which is a little bit more complicated than the ultimate year risk horizon. But, you know, solution to the ultimate year risk horizon is on our website. So let's click here and then go to the specific 1-year risk horizon. And this is something that you can look at any time you like. But I've also designed a PowerPoint display, and this is where we are going to spend most of our time on this session. So let's go to my PowerPoint display. Let me open it. Solvency II 1-year risk horizon. Okay. And we're going to skip quite a few of these transparencies. Okay, if you're looking at the economic balance sheet, that also contains the market value margin. So let's look on the right side of the balance sheet where we have the liabilities. We first have, this is only in terms of long tail liabilities, we have the expected present value of the future cash flows for the aggregate of all our long tail liabilities. And that's called typically the BEL, the best estimate of liability, suitably discounted. Then on top of that we have the market value margin. The market value margin is the cost of capital, risk capital. The capital providers, they provide the risk capital, and at the end of the period, at the end of the year, the market value margin, which is the premium for holding the risk capital, has to be returned to the capital providers. And on top of the market value margin, we have the Solvency Capital Requirement, the SCR. Now, according to Anne Hagen, an article in the Actuary, under Solvency II, the way that work is carried out will change. Technical provisions will be estimated as a probably weighted average of expected future cash flows. That's the cash flows by a calendar year, taking into account the time value of money, including the risk margin. The risk margin is the same as the market value margin. It is the premium that one pays, the insurer pays the capital providers for them providing the capital, the risk capital. So let me get the in color. Okay, under Solvency II, that's the main statement by Anne Hagen. Not only will we need to discount these reserve estimates requiring projected payment patterns, the only way you can actually calculate payment patterns is designing a PTF, probabilistic trend family based model, building a model that represents the trend structure in the paid losses in the 3 directions and the volatility, quantified volatility about the trend structure. And does say we'll need to demonstrate a deep understanding of the uncertainty of those reserves. From previous videos, you'll notice that there's a difference between uncertainty and variability, 2 distinct concepts. We know about definitions of VARs and TVARs. We've dealt with that. Here's one of the directives. It says that For example, the data of sufficient granularity and includes sufficient historical information to identify trends and understand characteristics of the underlying risk. And we believe it's only PTF and MPTF type models that actually allow the actuary and the various people in the company to understand their risks, correlations between the risks, and so on. The data are consistent with the underlying assumptions of the actual and statistical technique. Now, it's the other way around. The model, the technique, has to be consistent with the information in the data. In other words, all the assumptions made by the model need to be carried by the data, and that's exactly what we do in PTF type framework and the NPTF type framework. Okay, let's look at one of the articles. Article 76, the value of the technical provisions shall correspond to the current amount insurance and reinsurance undertakings have to pay if they were to transfer their insurance and reinsurance obligations immediately to another insurance or reinsurance undertaking. Best estimate or best estimate of liability, BEL, corresponds to the probably weighted average of future cash flows. Well, probably weighted average is just the mean. It's the mean of a distribution, and it could be, you're going to take into account the value of money. In other words, it is discounted. So the best estimate shall be gross without deduction of the amounts recoverable from reinsurance contracts and special purpose. Those amounts shall be calculated separately. Okay, the risk margin. What is the risk margin? Which we also call market value margin, shall be such as to ensure that the value of the technical provisions, incidentally, the technical provision is the best estimate of liability plus the risk margin. So the technical is equivalent to the amount that insurance and reinsurance undertakings would be expected to require in order to take over and meet the insurance and reinsurance obligations. Okay, so basically the technical provision, which is the sum of the BEL and the market value margin, the risk margin. The BEL allows you to pay for the mean liability, and the risk margin is the amount of money, the premium you need to pay the capital providers for raising the risk capital, and that allows you to conduct your business. Okay, for the 1-year risk horizon, risk capital is raised at the beginning of each year. In fact, that's the definition of the 1-year risk horizon. Risk capital is raised at the beginning of each year. It is also released at the end of the year, depending on the losses, the size of the losses. But at the end of the year, you also need to pay the capital providers the market value margin. So the cost of raising the risk capital, the market value margin, or premium on the risk capital, is paid to the capital providers at the end of each year, along with any unused risk capital. The sum of the MVMs and the best estimate of liabilities for each calendar year is the technical provision. In fact, you can define the technical provision for any year K. For year K, it's the sum of the best estimate of liability, which is just the mean reserves, the mean loss, suitably discounted, and the market value margin for that year is the cost of capital, the cost of risk capital that has to be paid to the capital providers at the end of the year. You raise the capital at the beginning, and at the end of the year, some of the capital, risk capital, goes back to the capital providers, depending on the size of the losses, but you always pay back the market value margin. Now, BELs, means, and market value margins are additive. Now, our solution to the 1-year risk horizon is tractable and also is non-recursive. It's not circular, contrary to a lot of other views. There's no circular argument here, as you should see. These are a little bit of definitions. LK is the random variable representing the undiscounted losses in future calendar year K. PVK is just the discount that is applied to year K, so it's just defined by 1 over 1 plus DK. D typically represents the risk-free rate. So the BEL is the present value adjusted sum of the means of the calendar year liability distributions. So the BEL is the best estimate of reserve, which is the sum of the mean losses in year K multiplied by the discount factor. Once again, the risk fund is not part of the technical provision. It is made available on a yearly basis by a pool of capital providers in return for a fee equal to the interest on the available funds plus the spread. Let's call S the spread. So the market value margin, in fact, let's go to the next slide. Let's suppose at the start of year K, you raised the VAR for year K at 99.5%. That's according to one of the directives. The first year or calendar year is in distress if you reach the 99.5 percentile or quantile. So let's suppose at the beginning of the year you raise the capital VAR, the VAR for year K. The market value margin, the amount of the premium or the risk margin you need to pay to the capital providers at the end of the year, irrespective of the size of the losses, is the spread multiplied by the VAR. You also need to return to them the risk-free rate of return. The risk-free rate also. So the market value margin discounted to inception is S by the VAR multiplied by the discount rate. The risk-free rate of return that you earn on the VAR, assuming the VAR is in fact invested, well, that goes back to the capital providers in any case. Okay, so if we go back to the previous slide, the MVM is the sum of MVMs. The technical provision at inception is the sum of the bells. The bell is the sum, the BEL, the sum of the bells over all years, and the sum of the MVMs over all years. So this is just definitional. Okay. There's more on our website. Let's look at some of the other directives. The Solvency Capital Requirements shall correspond to the value at risk of the basis owned funds subject to confidence level of 99% over a 1-year period. Okay. Incidentally, the technical provisions, another term for technical provisions is fair value of liabilities. So the technical provision is the market value margin plus the best estimate of liability. Let's look at another directive. Well, this is not a really directive. This appears on the EOM, Insurance EOM website, and trying to decompose Solvency II directives. And let's look at the main statement here. The fair value balance sheet is one of the cornerstones of Solvency II, and its impact is not restricted only to the calculation of fair value assets and liabilities. The concept of market value margin and the related 1-year risk approach in the calculation of the Solvency Capital Requirement find their origin in this fair value-driven approach. Okay, this is key. Insurance companies or reinsurance companies should have enough capital on their balance sheet to cover the risks that it can emerge over a 12 months time frame and allow for a theoretical transfer of all contractual liabilities at the end of this balance sheet period. So, you have a sufficient SCR, Solvency Capital Requirement, on your balance sheet so that you can sustain the next calendar year being in distress at the 99.5 percentile, and at the end of the year be able to rebalance your balance sheet, so to speak, so that you continue in business or sell your liabilities to another risk-bearing entity. In other words, you have sufficient BEL and sufficient market value margin. You've got sufficient BEL, best estimate of liability, to pay for perhaps the additional mean reserve, and also have sufficient market value margin to raise risk capital to continue your business. Okay. Here's another. Consultation paper 75. The SCR is the difference between the basic owned funds of the 1-year time horizon in the distressed scenario. Distressed is 99.5 percentile for the first calendar year. Incidentally, when we're looking at loss reserving and the 1-year risk horizon, we're just looking at the portfolio and runoff. This implicitly suggests that the undertaking should analyze the difference between all component parts of the technical provisions under the stress scenario. including the risk margin. So all these directives and consultation papers lead to the following definition. The above extracts lead to the following definition. The SCR for the 1-year risk horizon is the value at risk for the first year. So it's the amount of capital you need to sustain a distress situation for the first calendar year, the next calendar year, plus the change in technical provisions in the subsequent years suitably discounted, conditional on the first year being in distress. So let's look at this definition. SCR, first of all, you need to have sufficient capital for the first year being distress. Conditional on the first year being in distress, you need to have additional technical provisions. In other words, additional BEL, extra BEL, extra mean reserves, extra MVM, so that you can continue with your business. Or, alternatively, sell your liabilities, transfer your liabilities to another risk-bearing entity where they therefore have sufficient BEL for runoff and they have sufficient premium or market value margin to raise risk capital to continue the business in runoff. Now, what are kind of the tools we need? What kind of information do we need to conduct these calculations, these Solvency II metrics? So the calculation of technical provisions, market value margin, SCR, we need the probability distributions of paid losses liability stream by calendar year and their correlations for each line of business and the aggregate of LLRBs. And you know that with ICFRS Plus, when you look at a single composite model for the aggregate of all LRBs, it also includes the various types of correlations between the long tail lines of business. We need the probability distributions of total reserves for each LRB and the aggregate of LRBs. We need conditional probability distributions, conditional on the first calendar year being in distress, being at the 99.5 percentile. Now, armed with all these distributions, using explicit assumptions, based on the volatility in the data in the past, we can actually calculate any risk measure we want, not just the S2 regulatory risk measures. Let's suppose we look at a simple case, again, 1-year risk horizon, and a simple case of a 1-year runoff. For a 1-year runoff, everything is pretty straightforward. Okay, you've got the best estimate of liability, so it's the mean reserves for that next calendar year. I mean a 1 calendar year runoff. Okay, everything is going to be paid. Basically, 100% of liabilities are going to be paid in the next calendar year. That's the mean reserve. It's suitably discounted. It's the mean of the losses in calendar year 1. And we only discounted by half a year because at inception, at the beginning of the year, we can assume that the paid losses are made uniformly over the year. The SCR1 is just the VAR, the value at risk at 99.5%. The market value margin is the capital you raise multiplied by the spread discounted to the beginning of the year. Because you remember, the market value margin you pay back to the capital providers at the end of the year. So you hold it for 1 year, you therefore discount it. Whereas the mean reserves, on the average, you only hold for half a year, because if you pay it uniformly. Okay, what if instead, this really assumes that the risk-free rate you actually earn on the VAR, but the risk-free rate that you earn on the VAR, you've got to pay back to the capital providers anyway. Let's suppose that you don't earn the risk-free rate on the VAR. In other words, if you like, the extreme case, it's not invested at all, then NVM1 is SCR1 S plus D on 1 plus D. So you also have to apply the risk-free rate D on the SCR1. So really, whether you invest the risk capital VAR or don't invest it at all you do is, in this formula here where you have the S, you substitute the S plus D, and that's pretty easy. The technical provision is the BEL plus the market value margin. So let's suppose in the next year, you are in fact in distress. If you are in distress, you consume Bell 1, that's all gone. The VAR is gone, and at the end of the year, you pay the market value margin to the capital providers. Now, next simple case is 2-year runoff, and we assume there are no correlations between the years. Well, that's pretty straightforward. In year 1, you have a Bell, the mean, a market value margin, the risk capital. The years are not correlated. In year 2, you also have a mean, which you discount to inception. You've got a market value margin, which you don't have to pay until the end of the second year, so you discounted that by 2 years, and you have the risk capital that you actually raise at the beginning of the second year. So at the beginning of the first year, you raise this risk capital. Well, actually, at inception, let's do it this way. These 2 years, it's the same story. 2 years, completely uncorrelated, okay? So really at the beginning, at inception, you have the sum of the means, you have the sum of the market value margins, and you have the risk capital that you raise at the beginning of the first year, okay? So at inception, you've got to have your market value margin in your balance sheet. You've got to have the sum of the bells, the bell in your balance sheet, and that's called a technical provision. But the risk capital you only raise for 1 year, okay? All right, so let's see what happens if you're in distress in the first year. You consume Bell 1. The MVM 1 is paid back to the capital providers. You consume all that. Because the years are uncorrelated, the Bell 2 goes in there. The MVM 2 goes in there. You raise the risk capital RC2, and at the end of the year, you pay the market value margin MVM2 at the end of the year. And that's assuming the 2 years are not correlated. And some of the algebra is there in terms of discounting and spreads. Okay. What if instead now, this is fine except for one thing. What if the distribution for the losses in year 2 has changed, conditional on the losses in year 1? Simply put, the previous picture assumes there's no correlation between the distributions. In other words, if you're in distress in the first year, it has no impact on the second year. But typically, calendar years are correlated through parameter uncertainty. Now, the Equifax type models, the PTF modeling framework and the NPTF modeling framework, are the only frameworks that we're aware of where you actually have explicitly the distinction between process variability and parameter uncertainty. Every time you make a forecast, all the assumptions going forward are explicit in terms of trends, volatility, and also in terms of the uncertainties in the parameters. So let's assume now the 2 years are correlated, and let's look at the second year first. Let's assume now that the 2 years are correlated and the first year's in distress. Okay? Now, if the 2 years are correlated, well, let's just assume the 2 years are correlated. And never mind that they're in distress. We'll get to that later. If the 2 years are correlated, then the distribution of the losses in the second year are dependent on the losses, or the losses actually observed. The losses arrived in the first year. So now you've got correlations between these distributions. Okay, and these correlations play a very important role in determining the change in technical provisions for the second year. So let's now assume the first year's in distress. If the first year in distress, the mean reserve for the second year is no longer the unconditional mean. If the correlations are positive, this typically would be higher. If the first year is in distress, then the risk capital that you need to raise for the second year is not the same anymore. It's not the same as the risk capital, the unconditional risk capital, and the unconditional VAR. So now typically you might have to raise more risk capital. As a result of needing to raise more risk capital, your market value margin will be larger. Okay? The market value margin will be larger. So correlations means that if the first year is in distress, all the distributions for the subsequent years will be different. So it changes the total profile, the total picture in terms of the technical provisions, the conditional technical provisions, and the kind of capital you might need to raise for each year. So let's look at only 2-year runoff, assuming the first year's in distress, and let's look at the second year first. If the first year's in distress, the conditional mean might be larger. How much larger is it by, from the unconditional mean, we call that delta Bell 2. Now, you might have to raise additional capital, which we call delta VAR. There's a conditional VAR. This means that now the market value margin, the conditional market value, typically will be larger, so we have a delta MVM2. Now, this is a trick. If we now go to year 1, we start off with year 2. If we now go to year 1, what we do is we take the delta MVM2 and the delta Bell 2 and put it top of the risk capital that you need to raise for year 1, the VAR. So now the delta Bell 2 and the delta MVM2 sit on top. We don't put the delta Bell 2 in here. So now if you look at inception, you've got the sum of the means. Now the MVM1 changes now. MVM2 is still the same. MV1 now is based on this SCR, which includes the delta Bell and the delta MVM. Okay? So now, at inception, you've got the sum of the means, you've got the sum of the market value margins, but the SCR is the VAR and the delta Bell 2 and the delta MVM2. That's the trick. So there's no circular argument here, and the mathematics is tractable. Always look at year 2 first. If year 1 is in distress, if year 1 is in distress, these two components are added to the VAR. MVM1 changes, MVM2 doesn't. Bells are the sum of the bells. The sum of the MVMs is the market value margin in aggregate. You've got the VAR1 and the SCRs augmented. This is the delta TP, the change in technical provision. Okay, so what happens if the first year is in distress, the first calendar year? If the first calendar year is in distress, we consume Bell 1, we consume the VAR, and the MVM1, well, let's do it here. We consume Bell 1, we consume the VAR. The MVM1 also always belongs to the capital providers. We take the MVM2, so we take the Bell 2 and put it there. We take the MVM2 and put it there, assign it here to the second year. We take the delta Bell 2 and put it there, and we take the delta MVM2 and assign it there. Okay, so let's look at our balance sheet at the beginning of the second year now. At the beginning of the second year, we have sufficient mean reserves to pay for the conditional mean, now that the first year is in distress. We need to raise more risk capital, but we've got the additional market value margin to do that to pay the capital providers. So our balance sheet has been reconfigured or rebalanced so we can continue conducting our business. In fact, we can transfer our liabilities for the second year to any other risk-bearing entity because they will then have sufficient Bell. The technical provisions have been augmented by the additional Bell and by additional market value margin, which means now they have sufficient mean to pay for the additional mean, and also they have sufficient premium risk margin to go to the capital providers and obtain the additional risk capital. And the same arguments, this is just some of the algebra, which you'll find on our website. So you can see now that SCR is just the VAR plus delta TP2, the additional technical provisions for the second year, assuming the first year is in distress. And of course, we can do this now. Incidentally, delta MVM2 is only discounted by 1 year, whereas MVM2 is discounted by 2 years. Why is that? Well, MVM2 is part of the technical provisions. Okay? MVM2 you only pay at the beginning of the second year to the capital providers. You raise the capital at the beginning of the second year, you pay it back at the second. So MVM2 you actually hold for 2 years. Now, Delta MVM2 is not part of the technical provisions. It's actually part of the risk capital. And the risk-free rate on Delta MVM2 in the first year goes back to the capital providers. Okay? Delta MVM2 is then assigned to the balance sheet at the beginning of the second year here. Okay? And therefore, it's only discounted. It then becomes, let's look at another way. The Delta MVM2 for the first year's risk capital, the risk-free rate goes back to the capital providers. The Delta MVM2 at the beginning of the second year becomes part of the technical provision. Okay? And therefore it's only discounted by 1 year. Let's just see if I'm right. Yeah, only 1 year. Okay. This is a 3-year situation, the same arguments. And then we can go to an N-year situation, the same arguments. Okay, so what you need to do is millions and millions of simulations. Then out of those millions and millions of simulations, you would need to select somewhere around the 99.5 percentile, those samples, paths, that for the first calendar year or the next calendar year were under 99.5 percentile. Okay, that would be 1 in 200 will be in that percentile. And then out of those, you've got to do conditional simulations of what happens to the subsequent calendar years. So one has to do millions and millions of simulations to get a pretty accurate result of the technical provisions, SCR, and so on. Okay, out of the thousands of simulations, hundreds of thousands of simulations we did, here's a number of them that were actually in the 99.5 percentile in the first calendar year. Okay, it's going to become much more exciting when we do these calculations in the subsequent video. For one line of business and for the aggregate of 6 lines of business, the one line of business that we look at amongst these 6 is the most volatile, and for that you need huge SCR, huge technical provisions, whereas if you look at the aggregate of the 6 lines, you get a lot of risk diversification credit as far as SCR and so on. And the third video we're going to look at is consistency of these S2 Solvency II risk measures. What actually happens from year to year as you do your updating. You don't want to get a shock that all of a sudden you need much more risk capital. You don't want your model to be in distress, okay? Rather than actually having a distress situation in terms of